Welcome, everybody. For those of you that are joining in live, thank you so much. My name is Aaron Rheaume. I will be the host of our webinar today. If you can, throw in the comments section where you're viewing this from. And for those of you that watched the replay, if you have questions or things you want to ask FEG at the end, we are more than happy to answer those. So just throw those in the comments section as well, and our team will get an answer back to you. Give it just about 20 more seconds. I'm going to get started with content. So thankful you're all here. And again, today we're going to be talking about tax smart strategies and how to keep more of what you have earned. With that being said, let's go ahead and get started. My name is Aaron Rheaume. I am the Director of Financial Planning, a partner at the Financial Enhancement Group. I've been in this industry for a little over 20 years, started in December of 2005, and here I am moving into my 20th year, essentially in December of this year. So I've been an FEG team member for 11 years, and my passion is helping people with stewardship and really just working out and working through their biblical financial values. As I mentioned, my name's Aaron. I'll be your host. First disclaimer, I just have to let you all know that's watching, Financial Enhancement Group is an SEC registered investment advisor, meaning that we manage more than $100 million in assets. Just to give a small plug about the Financial Enhancement Group, we have offices, 4 of them here in central Indiana, an office in Georgia, and then we have families in 30 states that we take care of. Our business has been in business since 1997, and so we've got a team of great people that help serve our families here in central Indiana and across the country. So as we're getting set up today, I just want to remind you, we've been doing this video series throughout the year. We've got 2 more, one in October. We're going to talk about maximizing your impact and gifting assets. And then November 20th, we're going to understand your tax return, and so you can figure out how to build wealth. One of the things that we do here at the Financial Enhancement Group is we take our families on a financial journey. Each and every one of you that are watching and listening are on your own unique financial journey. In our families, we walk them through the 5 critical elements. The first of that 5 is your life after work. That's really just getting you set up for your life after work or retirement planning. The second thing, and we're going to focus on a lot of that today in the last 2 seminars, is tax planning. We also move into the investment playbook, risk management, and life happens in legacy planning. We feel with our 28 years of experience that if you're not paying attention to either one of these at all given times, it could derail you from it could derail you from you reaching your financial journey. So we have a proven process, we have a trademark process, and we walk our families through what we call the 5 critical elements. As I mentioned, tax planning, that's where we're going to focus on today. We manage our family's assets with their tax repercussions in mind, using multiple strategies to best capitalize on current tax policy. And there has been some major changes this year with the tax policy that went into effect on July 4th with the One Big Beautiful Bill Act. What we're going to cover today, and I'll try to wrap this up in somewhere between 35 to 45 minutes. We're going to talk about 8 really different things. I'm going to be bouncing all around. So as I move through some of these topics, if you have a question, just throw that into the comments section. If you have a question outside of this, if you're watching not the live recording, but just watching a recording of what I'm talking about, you can send questions to talk@yourlifeafterwork.com. So those are the 8 things we're going to talk through. We're going to talk about the difference between tax planning and tax reporting. We're going to talk through understanding income variability all the way down to charitable gifting, and then next steps that you can proactively take home and start working on. So let's talk about the difference between tax planning and tax reporting, because those are two drastically different things. Tax reporting is what you do the following year. So when you get your 1099-R statements, if you've taken money out of your IRA, your 1099 statements for interest earned, your W-2 wage income, tax reporting is compiling all of the documents that you had throughout this year and then reporting to the IRS what you did the following or the previous year. Tax planning, however, is proactive. Tax planning is making proactive and taking proactive steps that can today impact your financial future. What we do in tax planning most always has to happen prior to year end. Things that happen in tax planning would be any charitable contributions. Those have to be done before December 31st. Other things, if you're doing IRA to Roth IRA conversions, which I'll talk a little bit about today, that has to be done in this tax year. For those of you that take required minimum distributions, at age 70 and a half is when they first originated. That has now been moved to age 73. That has to be done before year end. Your HSA contributions, college 529 contributions, all of those things have to be done prior to year end. So there's a major difference. Just make sure you understand that they're both important. Tax planning is proactive. Tax reporting is reactive, and it's done the following year. We're going to move on to understanding income variability. And I bring this up is because there's a lot of things that can affect income over time. For those of you that are retired, you probably are on a fixed income. You may have Social Security, you might have pension, you may be drawing from your assets to help you maintain your standard of living. Other things that can help with that income variability would be if you're working and you get a large bonus in the year, maybe you sell some farm ground, businesses, real estate. All those types of transactions ultimately end back on your 1040. And so if you have years where income is going to be different than your normal, then there's things that you want to do to start planning around that. In a typical year, if you just have Social Security and you have a pension, you generally just have a standardized income coming in. But if you have farm ground that you sell, depending on the capital gains, that could potentially push your tax brackets higher. And we'll walk through how marginal brackets work here in a little bit. So just pay attention. If you see things that are irregular, you have to understand how it's going to affect your tax return in that given year. So if you're doing planning on your own, make sure you're paying attention to income variability. If you're working with a fiduciary advisor or an advisor, make sure they're paying attention to how taxes and income affect your retirement. So how do unusual spikes or dips in income create opportunities or risks? That's just like I said, if you're status quo and you have that Social Security and pension coming in, but you sell real estate, it could add actual capital gains to your tax return that were unaccounted for, ultimately making you pay higher income tax than what you may or may not have wanted. Business sales. We see this a lot of times here at Financial Enhancement Group. Someone's started a business, grown it over the number of years, and decided, hey, it's time to exit. And they have a purchase that happens. And normally they're, making money through their payroll or profit. And usually from year to year, that could be up or down depending on how the business has done. But in that large year that you sell the business and you get a big cash influx, how can we do things to hopefully offset some of that tax, and paying attention to what that does to your tax return? So if you're paying attention to the income, it helps in the future of what you can do with tax planning. There are 4 keys to tax efficient retirement. The first one is managing investment risk and volatility. A lot of what we see and hear on the news is the S&P 500 has done this today. The Dow Jones is doing this today. Risk and volatility are two separate things. Risk is the chance that if you make a bad investment, you could lose your money. Volatility is the market going up and down over a period of time. As you're walking through what we call our three phases of finance, that would be accumulation, preservation, and distribution. These are important things to manage, especially in distribution. You have to manage risk. You have to manage volatility. The second thing that we want to pay attention to is minimizing hidden fees and expenses. Know what you're paying for. Some of our investments have carry costs to them, especially mutual funds. They have carry costs. So know what those expenses are. If you're working with an advisor, understand how their fee schedule works. If you're working with someone that's not an advisor, but they're trying to sell you a product, understand what's inside of those types of products. Are there hidden fees? Are there hidden expenses that you haven't paid attention to or that you weren't told about? So paying attention to those things, if you're having low fees, low expenses, ultimately that means more dollars that you get to keep. The third thing is taxes. And it's not just taxes today, it's taxes today and tomorrow. We want to make sure that we're looking at the tax return this year, but we also want to make sure we're looking at your tax return for the next 5 years and 10 years. As you continue to age, life happens. There's curveballs that can be thrown your way, and we want to make sure that we're paying attention to it. Some of the strategies that I'll talk about later on today help set up for tax planning, not just today, but for today and tomorrow. And it's not just for you, it's also generational. So if you have any wants or wishes to be able to leave assets to the next generation, you also have to pay attention to how those taxes affect that next generation. And then lastly, we need to get a real return. And all real stands for is inflation. So if your dollars or your money is not outpacing inflation, then the cost of living can erode some of your assets over time. Here in the United States, for the last few years, we've been in a high inflationary period. We haven't been in this high of inflation since the late 70s, early 80s, and we've seen some cost of goods go up. Things are more expensive today than what they were a few years ago. So just paying attention to all of those things can help you not have your hard-earned dollars eroded by unnecessary fees and expenses, unnecessary taxes, and potentially not getting enough return to meet your standard of living because you have assets that are not outpacing current inflation rates. As I mentioned, I've been doing this for 20 years, just about 20 years here in December. So I want to talk through a couple pitfalls. And just a reminder, as I'm talking, if you have questions, please send those into the chat section or the comment section, and I will do my best to answer those as we go along. So a few pitfalls to avoid. First one that we see is misunderstanding how short-term versus long-term capital gains rates work and how they're taxed. In order to describe that, we first have to identify what a short-term capital gain is versus what a long-term capital gain is. Simply short-term means if you hold an asset, if you purchase it and you sell it before 12 months is up, then you could potentially have a short-term capital gain. Let me take a step back. Let's first describe what a capital gain is. I purchase a stock for $10. Over a period of time, that stock grows to $100. Now there's a $90 difference in that share. If I were to sell that stock, there would be a capital gain of roughly $90. Now, if I did that in the first 12 months, that would be a short-term capital gain. However, if I held it for 1 year and 1 day, that would be a long-term capital gain. Those two types of gains are taxed differently. Short-term capital gains are taxed at ordinary income rates, which I'll talk about here in a few minutes. And long-term capital gains are taxed at long-term capital gains rates. Long-term capital gains rates can be anywhere from 0 if you fall in the right tax bracket, 15%, all the way up to 20%. And if you have a higher income, you could get a 3.8% net investment income tax surcharge. So capital gains tax long-term could be as high as 23.8%. The next pitfall that I see, or that we see in the office, is when you're doing your planning, you forget to include the state level taxes. A lot of what we as advisors talk about are marginal rates from a federal perspective. If you live in a state that has state income tax, we want to make sure that that is planned for and around things that you're doing. So if we're going to move money from an IRA to a Roth IRA in the form of a conversion, we have to not only factor in federal tax, but we also have to factor in the cost of state taxes in doing that conversion. Another pitfall is overlooking tax loss harvesting. And so when I was talking just a brief moment about short-term versus long-term capital gains, one way to offset some of those, if you've recognized the long-term capital gains, is tax loss harvesting. What that is looking through your portfolio and seeing if there's any underlying positions that may not have a capital gain. Not all stocks are winners when you buy them. So maybe you bought a stock that actually went down in value. You could sell that stock and take a loss on it, which would offset your capital gains tax. Lastly, one of the biggest things here is looking at not saving in the right types of tax advantaged accounts. I just want to take a brief minute to walk through this. If you're new to our series, if you're watching for the first time, I have always said, and we say here at the Financial Enhancement Group, you are on your own unique financial journey. You and your spouse, or you if you're single, are on your own unique financial journey. From an academic standpoint, we tend to put people in boxes. We tend to say, okay, here are the masses of what people should do. But just remember, that doesn't mean that that's going to fit you per se. So you're on your own unique financial journey. So another common pitfall is missing out on saving in the right tax advantage accounts. For some people, it makes sense to save in the 401k. That is tax deferred. You can also have a Roth 401k that would be taxed at a income level, which grows tax-free, and distributions are tax-free. IRAs are tax deferred if your income's below a certain amount. Roth IRAs, again, are tax-free. HSAs, those are really good from a tax benefit. Dollars are tax deferred. If you have it invested, you can grow those investments. They'll grow tax-free. And as long as you distribute those for health-related reasons, the distribution of those funds are tax-free as well. And then 529 plans are usually college savings plans, and some states offer benefits to contribute to those. Okay, so taking a step back, right. What does right mean to you? It really just depends on your tax bracket. And I'll go again into those in a few minutes. But if you are in a 10 or 12% tax bracket, it may not make the best sense to contribute tax deferred dollars inside of those brackets. If I were telling a younger person who's just starting out in their career, hey, I want to give you some advice. You have a 401k plan. Go start saving in that 401k plan because the employer gives a match. Well, that's all good. But if there's a Roth option inside of that 401k, it may make the most sense for that person to save in the Roth portion of that because their tax bracket is at 10 or 12%. Now, if you're in higher brackets, it may make more sense to tax defer some of those dollars. Making sure that you're building accounts in the right tax advantage accounts also will help you in the future when you get ready to retire and move on into distribution. All right, let's move on to some strategies to consider. As I was talking about, we're going to talk through a strategy called bracket bumping. on the screen, you can see our marginal tax brackets. These are our federal tax rates. At the bottom of the bracket, we have the 10% marginal bracket. It goes to 12, 22, 24, 32, 35%, all the way up to 37%. And these brackets really just matter on where your income is at for that given year. And one thing that has been made permanent this year is these brackets have been made permanent. What had happened in 2017, there was the Tax Cuts and Jobs Act, which reduced these marginal brackets. That 12% bracket in 2017 was actually 15%. The 22% bracket was 25. The 24% was 28. And then all the way up to the top, that 37% bracket was 39.6%. That has been made permanent this year. So if you were to come into the office and you asked us, hey, am I on track or off track for my retirement journey? One thing that we're going to have to sit down and have a conversation with you about is, what does it take for us or for you to maintain your standard of living? That is such a critical component of helping people with your life after work. Think of your standard of living as the nasty word budget. It is a word that people don't like to pay attention to. Budgeting is not fun. We don't want to track where dollars are going, but I'm confidently telling you, when you move into your life after work, you need to pay attention to your budget. And so what budget stands for in our language is standard of living. I want to know what it takes for you to maintain your standard of living. Academically, if you look at the academic side of things, and here I'm going to make a reference back to you, you're all unique. Academically, we would tell you that you need to replace 70% of your income. So if you made $100,000 a year, you need to replace 70% of that. That is $70,000 a year. However, let's say your living expenses, because your mortgage has been paid off, you're not carrying any car notes, your credit card debt is paid off every single month. Maybe it takes you $5,000 a month to live. Well, 5,000 times 12, the last time I checked, is $60,000 a year. So there's a $10,000 difference. That's not a huge difference in the overall grand scheme of things. But if you multiply that $10,000 out year after year after year through retirement, it could push you off track just by being $10,000 off. So knowing what that standard of living is vitally important as you're moving into your life after work. So again, in that example, let's just say, you need that $5,000 a month to live. That would push you right comfortably into that 12% tax bracket. So in our case, from a tax efficient strategy, for those of you that have saved well, you should likely use dollars that are tax deferred in those lower brackets, like an IRA or a 401k, which ultimately should be moved to an IRA after you leave your employer. If you have an income need that pushes you above that 12% bracket, that is where you would start to use your other sources of income. What other sources of tax-free income? That would be a Roth IRA. It could be a brokerage account if you're paying attention and keeping the capital gains minimal. So most folks, from what we have seen here at FEG, do not carry a lower income need into their retirement. Generally, they're making essentially a heavy portion of what they have made as their earning years. Social Security kicks in, RMDs will kick in the future. For those of you that are blessed with a pension, you have pension incomes that are kicking in. We call those mailbox checks. Those are things that start and you cannot turn those off. So what you want to do is add those mailbox checks up. take your Social Security if you've started it, your pension income, determine how much that is on a monthly basis, and that starts to fill up your marginal brackets. Anything that you need over and above that is where you could start to use your tax-free Roth dollars or savings or brokerage account. One thing that I did mention is building tax diversification helps with flexibility in retirement. If all of your dollars are tax deferred in one bucket, you can't control when tax rates change like we've seen over the past couple years. You need to have flexibility. You should build tax diversification in between three different types of accounts. One would be tax deferred IRAs. Two would be tax-free Roth IRAs, and then having money in a savings account or a brokerage account where you get a 1099 on each and every year so you pay taxes. The more and the diverse types of accounts that you have, the more options you have, the more control you have when you move into your life after work. Here at FEG, we're a very big component of the Roth. And so Roth IRAs, there's two C's to those. The first is contribution. Those are funded with earned income. So if you're retired and don't have any earned income, you can't contribute to a Roth IRA. If you're working and have earned income, you can contribute to a Roth IRA. There are annual contribution limits. Inside of the Roth IRA currently in 2025, you can add $7,000 to a Roth IRA individually. And if you're under age 50, if you're over age 50, you can put an additional $1,000 into that Roth IRA. And you can do that per person. So if you're married and have a spouse, you can contribute somewhere between you can contribute between $14,000 and $16,000. And it is limited to the amount of money you make. So as you start to get into some higher income brackets, it phases out, I think around $230,000 this year starts to phase out when you can contribute to the Roth. Now, the other strategy and the other C is actually what we call a conversion. And this is where we move money from tax deferred accounts to tax-free accounts like a Roth IRA. What this does is it creates tax-free dollars for future withdrawals. Let me go back just a couple slides here, and then I'll make a point. So if you're if you're in this marginal tax bracket between 10 and 12, sometimes it makes sense if you're not filling that full bracket up to move dollars out of an IRA and push it to the Roth and pay a 10 or 12% federal tax rate. Another part of that strategy is it could impact some of your Medicare premiums. So we want to make sure we're paying attention to that. So if you're on Medicare, you know that you have monthly premiums amounts. That is always 2 years in the arrears. So what you earned in 2023 dictates what your 2025 Medicare premiums will be. So what we do in 2025 will affect your 2027 Medicare premiums. So pay attention to that. A lot of people don't like to pay those higher premiums. I think it's right around $196,000, $194,000 before that bump starts to happen if you're married filing jointly. Another strategy to pay attention to is, especially with IRA dollars, is doing what's called a qualified charitable distribution or donation. This becomes available once you reach age 70 and a half or older. So you have to be 70 and a half or older to be able to do this. It allows you to directly transfer from your IRA to a qualified charity. What a qualified charity is it's a not-for-profit, a 501c3. And so if you have tax-deferred IRA dollars and you're charitably inclined, it may make sense for you to use what's called a qualified charitable donation. How most people have given is simply through cash by writing a check. And so if you're currently writing checks, just look at whatever marginal bracket you fall on, and those checks that you write essentially are a cost to how much you could save. So if you are in that 22% marginal bracket and you're writing a check versus using a QCD, you're paying an extra 22 cents on that check just to be able to donate. So if you rethink how you want to give or your giving strategy and your tax or you're over age 70 and a half, start to look at IRA dollars to give. One other caveat, let's say you want to give money to the church. It can't be for something specific. So let's say the church is going through a building campaign and they need dollars to help with the building campaign. The qualified charitable donation or distribution has to go to the general fund. There can't be any strings attached. The church or whatever charity then can decide what to do with it after you make that donation. Another key point is if you're filing your own taxes or you're working with a tax professional and you use the QCD strategy, make sure that is notated on your tax return. With a QCD, you do not get a tax deduction, but it's not included as income on your tax return. So a lot of the custodians like Charles Schwab and Fidelity, they will send you a full 1099-R listing how much money you've taken out of your IRA, but you have to remember, okay, I've taken a $50,000 distribution this year. I gave $10,000 out of that to the church. So only $40,000 of my distribution should be taxed. It is notated on your tax return. It should be notated with the initials QCD. Some other ways to avoid to give, we see stock. I'm going to do a different series on that. I'm going to dive deeper into charitable gifting. So one of the important things to do prior to year end and proactively is use that QCD. Some practical tools for folks is really understanding and evaluating your adjusted gross income and your taxable income. Most people, let me take a step back. Not most people. Often people believe what they pay taxes on is their adjusted gross income. That is not true. Your adjusted gross income is what shows up on generally a line 11 or 12 of your tax return. It totals or compiles all of your income. So it looks at your W-2 wages if you're still employed, if you have any business income, interest, dividends, capital gains, all of that stuff compounds to add to your what we call your adjusted gross income. What your taxable income is it's your AGI minus your standard deduction or your itemizations. And so currently our standard deduction has been made permanent. That was one thing that was a part of, I think, this first Secure Act in 2019. We raised the standard deduction from roughly $14,000 as a married couple to like the $24,000, $25,000 range. So most people now just take the standard deduction because it's so high. If you itemize, things that you can itemize would be mortgage interest, your charitable contributions, state and local tax, or it's also called SALT tax. Those are things that can be itemized. As long as your itemizations are higher than your standard deduction, then you would take your itemization. So adjusted gross income minus your standard deduction or your itemization, that gives you your taxable income. So there's a couple things with that is there's a strategy called double stacking that I wanted to talk about. We use this in practice. Go back to what I just said about itemizing. Let's say your charitable contributions, your mortgage interest, if you have it, your state and local tax. And one that I didn't mention is if your medical expenses are higher than a certain percentage of your adjusted gross income, you can deduct those as well. So let's say, through mortgage interest, your charitable contributions and your SALT tax, you're roughly at $30,000 of itemizations, but married filing jointly, your standard deduction is roughly $32,000. That's a $2,000 difference. You'd likely take that standard deduction. However, you could potentially do what we call a double gift. So if a large portion of that itemization was charitable gifting, what we would encourage you to do is actually give 2 years worth of your gifts in 1 year. So if you normally give $20,000 to the church, we would have you give $40,000 that year, then add in your mortgage interest and your state and local taxes, and you get a much larger ability to itemize versus losing it all. And then the following year, we would have you take the standard deduction again, and then wash, rinse, repeat. So that's what we call double stacking. If you're getting close to that itemization line, and a lot of it's coming from your charitable gifts, then we would double gift that every other year. Some ways to give, we've talked about this, is going through your QCDs, going through appreciated stock donations, donor advised funds. I'm going to do a whole different webinar on that in the next coming months. So some next steps that you can take, practical next steps, is really review your current year's income and where you're at from a bracket position. Know where you're at, know where your standard of living's at, know what it is on a monthly basis, on an annual basis. Another thing to do is identify opportunities before year end. And so, if there's charitable things that you want to do, make sure you're doing those before year end and know how it's going to affect your tax return. If you haven't made specific contributions to like your HSA account or 529 plans, make sure those are being done prior to year end. Discuss, like I said, your charitable gifting strategies with your family. Discuss those important things prior to year end. And if you're working with an advisor, make sure you schedule repeated annual tax planning reviews. Here at FEG, we save the last quarter of the year so that we can run our annual tax planning meetings for our families. We want to make sure that there's no differences and variances in income like I talked about. So if a business was sold or real estate was sold, how does that affect their tax return prior to year end? We want to make sure those things are done, and we have hundreds of tax planning meetings every year to make sure that our families are the most tax efficient with the strategies that they have. I covered a lot of information in a short amount of time. For those of you that are live, do you have any questions that I can answer? I'll pause, take just a minute, see if any questions come into the chat. For those of you that are watching the recording, again, you can send questions to yourlifeafterwork.com or just post them in your comment section, and we will follow up with you. Give it just a few seconds here. All right, wrapping up. Tax planning, it equals peace of mind and lasting impact. As we talked about, there's a major difference between tax reporting and tax planning. Tax planning's proactive. It's making sure you're getting things done prior to year end. And because of the proactivity, it can have a lasting family impact. It can also give you peace of mind knowing that you've done the right things. As a reminder, October 16th, we're going to talk about gifting appreciated assets. I did very, very brief amounts of that today. I'm going to go into more detail and some strategies on that. If you have questions, again, send them through the chat. If anything that I said today sparks your interest, schedule a next steps meeting. That's where my team, one of us on the team, We'll sit down with you for 90 minutes. We'll give you things to think about today, things to think about in the future, and if we decide to partner together, a written plan for what FEG will do for you. I want you to scan that QR code on the screen, schedule a meeting. That way we can sit down and make sure that we have helped you on your unique financial journey. Thank you so much for watching. And for those of you that are joining on the recording, thank you as well. You all have a blessed day.